Okay, folks, welcome to Best Stock Charts for the new trading week. Bob Desmond here at the Contrarian Trader. And what we're going to talk about today are not necessarily stocks that we would talk about trading for the new trading week. What we're going to talk about today is more of a strategic approach to the re-industrialization of the United States. Now, I've mentioned this on recent live streams. We do 2 live streams each week, Sunday nights and Thursday nights. If you're not joining in on those live streams, we have a great time. Please click that like, subscribe, notification bell. Also, we have a 5-part video tutorial on our five top favorite candlestick patterns linked below, free of charge, and you'll get notified when we do go live 15 minutes to a half hour. So the reindustrialization of the United States, as explained by the Harvard Business School Review, is this. Talk of reindustrialization in the United States has been supported by a seeming resurgence in manufacturing, but this is driven more by end-of-labor arbitrage and an increasing coordination costs of offshore manufacturing. So let's pause there. What are they saying? What they're saying is that the benefit from the very, very low wages in third world countries, including China, that arbitrage, that benefit, you're seeing a lower return on because wages in other countries have increased, whereas in the United States, wages by and large are not increasing. And in fact, they're fairly stagnant. And don't forget, when you manufacture overseas, there are transportation costs, etc., that need to be factored in as well. So there's a diminishing return on offshoring out of the United States. Moving on, aggressive restructurings and significant gains in worker productivity in the face of stagnant real wage growth has meant that productivity adjusted costs have made the U.S. more attractive for some sectors. And it's important to emphasize that it's only some sectors, not all sectors of manufacturing. Continuing on. But the offshoring of component supply chains limits the number of industries that may actually move back. Correct. U.S. manufacturing is not going to have the sector makeup that it had before the offshoring boom. Rather, China, and I'll pause there. I don't think it's just China. I think it is more so Vietnam, India, in particular India, Indonesia, etc. Those countries are going to benefit probably more so than China. Why? Well, we are seeing a lot of saber rattling between the United States and China over Taiwan and over various issues as well. Also, the Chinese did themselves no favor with the CCP virus. So moving on here, China, Vietnam, etc., will remain an important manufacturing partner for the United States, and it will be especially attractive for Europe. It will not be the obvious first choice for offshoring that it has been. Correct. Absolutely correct. And I think that goes back to what I was saying earlier. Vietnam, India, Indonesia, Malaysia, etc. Those names or those countries will benefit dramatically. So now that we understand what reindustrialization of the United States is, how do we play the game? But before we do that, let's talk about our week. How did we do last week? Well, we did really, really well. In the face of a weak stock market is measured by the triple Qs, not necessarily by the S&P 500 or in particular the Dow Jones, we did very, very well. Why? We were short going into the new trading week. We were short using put options. We were short using a leveraged ETF, the SQQQ. We remain short using the SQQQ. We booked our profits in our long put position. Also, we had a strangle, which is an option strategy, a cash flow strategy on Meta that expired worthless. That's good for us. Our strangle on NVIDIA, which we rolled down the call side strike on, very, very profitable. So a very strong week. So if you're not currently a member, please sign up for our 14-day free trial offer. Now, why am I still bearish on the overall market as we proceed into the new trading week? Because what I want to emphasize is that before we go into conversation about the stocks that I like going into the reindustrialization of America, I don't want to put these trades on next week. We want to leg in to these positions. Now, what you're looking at here, and we'll talk more about this tomorrow night on Sunday Night Futures Live, 6 p.m. Eastern Standard Time. So please join us. What we're looking at here is the bulls versus bears index. And normally when you shoot up higher, there's way too much bullish optimism, and overlaid here in black line is the S&P 500. And you can see that when you get these spikes, generally you get a correction. It could be shallow, it could be steep. But given the PE multiple on the S&P 500 and the fact that we have the yield curve, which is inverted, I'm going to go to that in a moment, I think that there's a very good chance that we see a significant pullback in the equity market, in particular your high-tech, high-beta names. So as we talk about the reindustrialization of America and the sectors and the stocks that I like, we need to keep in mind that we need to leg into these positions slowly. Gradually build your portfolio, because the reindustrialization of America is going to take a long time. You're talking about 10 years. So you don't need to do all of what I'm looking at here in terms of a strategic approach to the reindustrialization of America. You don't have to do it all next week. Okay, move on. So when China was building out, what did we see? We saw a massive, massive bull market in commodities. Now, as we build out the United States, you're going to need commodities. And what we're going to look at first, before we talk about the sectors that we like, is we're going to take a look at the GTX, the S&P GSCI Commodity Index. Now, what is this? We'll come back to the chart. We'll talk about what this is first. Highlighted in purple, the S&P GSCI is made up of 24 exchange-traded futures contracts that cover physical commodities spanning 5 sectors. The sectors currently include energy, industrial metals, precious metals, agriculture, and livestock. Now, we cover this every Sunday night, what the commodity space looks like. We know that livestock's been in fuego. The agriculture space had corrected. It's now bouncing back a little bit. Precious metals now bouncing back. We just traded platinum for a profit. We're going to be looking to re-enter platinum and gold for that matter. So let's go back to the chart and why I think that this is going to blast off. Before we talk about present day, I want to talk about from 1999. That's around the time where China was granted entry into the World Trade Organization. And that opened a lot of markets to China. They were granted a most favored nation trade status. And you could see what that did to commodities. Commodities simply took off. This was the build out of China. China has slowed dramatically since that point in time. But now you can see that we have now broken out on the GTX. And I believe that this is due to the build out, or the refitting, if you will, of the United States and, yes, other areas of the globe, India, Vietnam, Malaysia. We need to start thinking less about China, more so about its neighboring competitors and the United States as well. Now, moving into next week, we're going to have a Fed meeting. It is widely expected that they are going to, on the 26th of July, they are going to raise rates as sure as God made green little apples. It's not going to be a surprise. They are raising rates in July. And for that matter, as you look out over the course of the next several months, the markets continue to expect an increase in interest rates. So this could be stock market negative. So the reason why I'm pointing this out to you is that this is not stock market bullish, at least for the sectors that rely upon cheap money to thrive. Now, there's a saying that man plans, God smiles. So what we're looking at here is an expectation going all the way out to December. I'm not going to go any further than December, that the Federal Reserve is going to increase interest rates. There's only one problem with that, is this, the yield curve. And we're going to get to the stocks that we like and the sectors that we like with regard to the reindustrialization of America in a moment. We're not going off course. What I'm trying to do is I'm trying not to be hyperbolic. I'm trying not to be get rich quick. You got to buy these stocks next week. This is all a strategy. And to have a strategy, I need to understand what the obstacles are in the roadway for us in the short term. When I say short term, I'm talking about the next year, 2 years. Now, what you're looking at here is the yield curve. For those that are not familiar, the yield curve has predicted every single recession since 1955. How does it do that? Well, Overlaid here in gray is the S&P 500. The yield curve is in candlestick. And you can see that yield's inverted, meaning the 2-year treasury pays more than the 10-year treasury. That's not supposed to be. That is abnormal. That is unsustainable. And banks find it difficult to lend money in that type of environment because they borrow short-term, they lend long-term. That's their model. So when the yield curve inverts, meaning 2-year yields pay more than 10-year yields, like they did back here in 2000, like they did back here in 2006 through 2007, again in 2020, the resolution to the inverted yield curve is not good for equities. In fact, it's horrible for equities. We all know what happened during the dot-com bubble. That's when you had a steepening of the yield curve. We all know what happened back during the financial crisis. We all know what happened during COVID to the equity markets. It was not good. So here we are yet again. We're up on the month, well off the highs of the month. So we're beginning to show signs of steepening here, but we're not quite there. But when we do, when this gets resolved and we begin to move up higher, the Federal Reserve will be cutting rates, and they will be cutting them very, very aggressively. So as we see blood in the water in the equity market, that's when we want to begin building our positions very, very aggressively as the equities that we're looking at today become a lot more cheaper than what they are right now. Can we nibble? Can we take a bite at the apple? Sure. Do we want to get aggressively long of these names now in anticipation of a major correction in the equity market in the coming year, 2 years? No, because we can get a much better price in the longer term. So we want to build a position. So now let's talk about what we want to buy. The first sector up is going to be real estate. Right off the bat, real estate. Because if the Federal Reserve is cutting rates in the face of an economic crisis, you're going to have investors seeking yield. Now, this is Essex Property Trust. It pays over 3% yield. To be specific, 3.68% yield. And you get the benefit of upside potential. Because what you can see here on a monthly chart is that ESS has broken out on a monthly time frame. So not only do you have a yield that you're getting paid, you also have the benefit of upside potential on the share price. Another name that we like in this space is Avalon Bay Communities. Now, you could argue that, Bob, what does this have to do with the reindustrialization of America? This is a residential community operator. Well, that's true. It is true. But if you have wage growth in the United States due to the reindustrialization of the United States, Avalon Bay is mid-tier to higher tier apartments. They're very, very nice. I've been in them. Very, very nice. And Avalon Bay is an extremely well-run company. It is yielding 3.28%, and it is also breaking out of a resistance level. Now, we still have a few trading days left to go in July. Will we close here? We'll see on August the 1st if we close there. But what we're looking for is a continuation breakout on Avalon Bay, and you can see that momentum is building on Avalon Bay. So yet again, we have another play here where you have yield and you have the benefit of upside capital appreciation on the share price. So those are REITs. What else do you need? Well, you're certainly going to need utilities. And if they cut yields, the utility space is going to do very well. Why? It's because utilities are capital intensive. They issue bonds for expansion of their facilities or to maintain their facilities. Therefore, they compete with treasuries. However, if the Federal Reserve is cutting rates due to the yield curve steepening and the Federal Reserve is responding to crisis and they cut rates, who's going to benefit? Utilities. So you see how this all plays in together. This is a longer term strategic play. Now, the VPU is looking really good here. Again, this is a monthly chart. And by the way, we're using TrendSpider Automated Technical Analysis, 35% discount code below. If you're not using TrendSpider, you're missing an arrow in your quiver because a lot of people use this program. I know because I'm a reseller of the program and I get the reports. And people do not cancel. If I get 1 or 2 cancellations every 6 months, that's a lot. And I believe in it so much that I give it away free to our silver and gold level members. So link below, they give a 7-day free trial offer. I give a 14-day free trial offer. Let's get back to VPU. That's going to be the last plug. All right, so VPU, monthly chart, beautiful, beautiful setup here. There you have it, a wedge formation. You do have a little bit of resistance above at, let's say, 149.76. Let's take a crayon out and draw a line there. And what we want to do is we want to create an alert. We want to know when we break through. VPU monthly breakout, re-industrial play, and we're going to set this for 60 days. And we're good to go here. And I don't think I mentioned VPU pays a dividend of 3.19%. So very attractive. You're getting paid to wait. Another play I like for the reindustrialization of the United States is MLPX. And this gives you a bit of diversification because it's more global. So you're going to benefit from the build out of India, Indonesia, Malaysia, other countries as well, South America, which is obviously a continent, but those countries, Central America, Mexico. And you can see here the game has already begun because this is a monthly chart. We have been consolidating here since June of 2021. And what we're doing now is we're beginning to, in the month of July, break out. Now, the beauty of this is that it's begun to rally, it's begun to break out, and it also pays a dividend of 5.2%. So in a very attractive trade, and with all these names, what we'll be doing is we'll be sending out alerts to members as we build these positions. We'll be talking about this strategy, this portfolio with members on a consistent basis. So members, more to come. Now, this is an individual company. This is a waste company, and you're going to need waste removal. Monthly chart, WCN, Waste Connections, Inc. And what are we doing in the month of July? We are breaking out of a long-term base. We're very close to it. So we're going to be watching this because when we look at these long-term bases that have been going on since early 2021 with regard to MLPX, WCN, and other names, the longer the consolidation, the greater the validation of any breakout. We're looking at monthly charts. This means that these are not short-term trades if you're using a monthly chart. These are multi-year trades that we're looking to put on here, not necessarily what we normally do. But the reason why we're looking at these trades is because nobody else is really focusing on them, at least in the retail space. Now, Waste Connections does not have much of a dividend, but it does pay a dividend of 0.69%. I would wait for a validated breakout. So if we're above this upper band of resistance on August the 1st, well, then we may just be putting on a long-term trade here. We want to see a breakout, and we'll keep this active for 60 days. Now, one thing I want to point out before we leave Waste Connections, and I haven't spoken about this on other charts as well, these multicolored lines above or below, what those are resistance levels and support levels. I did not draw these support and resistance levels. This is the algorithm on TrendSpider that points that out for you. So keep in mind that as we rally here and we break out, assuming that we break out on WCN, we're going to have resistance up at around 153.49. I'll touch upon this with members as we track these trades. So if this is a multi-year trade and we rally up and into one of those resistance levels, perhaps we don't want to exit the trade. Well, we can always sell premium. We can always sell covered calls. There are options on WCN, so we get paid a small dividend. We can also pay ourselves a dividend vis-a-vis selling covered calls. Now, going back to this chart for a moment, this is the commodity index, and you can see that it is rising. Now, I have little doubt that if the stock market begins to correct heavily, like it did during COVID, like it did during the great financial crisis, like it did during the dot-com bubble, you are going to get a correction in commodities. They will pull back. However, as the Federal Reserve begins to stimulate the economy by pumping money into it, well, then they're going to create inflation. What's going to benefit? Commodities. Commodities will begin to rally. So they'll be the first to recover. But given that the Federal Reserve is responding to crisis and they're cutting rates, yet commodities are increasing in prices, guess what? That's inflationary. So what else must we own during a reindustrialization of America play post stock market correction? Well, we need to look at gold. We need to look at silver. And gold on a monthly time frame is flirting with a breakout. This is the GLD, flirting with a breakout. And don't get me wrong, if we do correct in the equity market, you're going to get a small pullback on the GLD, on spot gold, on silver. Probably a greater pullback on silver because it's also an industrial metal. But on that pullback, we need to be buyers of the metals. What else must we be buyers of? We need to be buyers of the gold mining stocks. Now, have no doubt that as the stock market corrects, these names are going to go down. You need to take a leap of faith as these names begin to correct and correct heavily, and think about dollar cost averaging into a trade in anticipation of Federal Reserve action to whatever economic crisis they're responding to, causing the yield curve, again here, to steepen, therefore causing the equity market to correct. That'll take down the gold mining stocks, but that is your opportunity. You need to look into the abyss and understand what's at play here, that in the short term, there will be deflation. And the reason why the GDXJ and gold prices are correcting is due to two reasons. One, forced liquidation due to the fact that margin calls are going out. Therefore, the stock prices are going down because people will sell anything to meet those margin requirements. Also, short-term deflation. That is not good for gold mining stocks, gold, etc. They don't do well in that environment. They like stagflation, slow growth with inflation, like in the 1970s and the early 1980s. And we also saw that after the dot-com crisis because China was building out, causing inflation, and gold went on a multi-year tear. Folks, if you get any value out of the reindustrialization of America, please leave a comment below. If you disagree with me, if you agree with me, leave a comment. Like, subscribe to the channel. Don't forget to join us Sunday nights and Thursday nights for our live streams, 6 p.m. Eastern Standard Time. Click that notification bell. And don't forget to take advantage of my 5-part video tutorial on my top 5 favorite candlestick patterns linked below. It's free of charge. Hope to see you on Sunday Night Futures Live. Be well.